Welcome back to the Equity Mates Summer Series. This is a podcast where we explore everything that's possible in the world of investing. If you've just joined the show for the first time, a huge welcome. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited for this episode. Continue to be excited for this series. We are up to episode 9 of our 12-part series, interviewing some of the best investors in Australia, unpacking lessons from their lifetimes of investing, and drawing out actionable insights to help us all make 2025 our best financial year yet.
Yes, and joining us in the studio today is James Miller, co-founder at Firetrail and portfolio manager of their S3 Global Opportunities Fund. He has over 12 years experience investing in equity markets, and today we are getting that many stock tips from him. It's not funny.
Yeah. I mean, it is not funny, even though you're laughing there.
Well, I mean,
stop laughing. It's not funny.
I can't help but laugh at how many stock tips we get.
Okay. I think we should start with Firetrail because it's a pretty interesting fund, and we've met a few of their fund managers over the journey. And one thing that really strikes me is a lot of them don't have a classic finance background.
Yeah.
James, as he explains in this conversation, is an engineer.
Yes.
So we've spoken to Eleanor Swanson before, who has like a biotech background.
Yeah.
We've also met Matthew Fist, who has like a mining background. And so I think it's just interesting that the perspectives that the Firetrail team bring aren't just your classic finance backgrounds.
No, yeah, which I think is important. It's great to, you need that diversity in an investment team to challenge each other and make better decisions.
Yeah. And James in this conversation talks about, his start in the investing world after jumping across from engineering was to go to Macquarie Bank right in the teeth of the GFC.
Just before.
And the Macquarie story in the global financial crisis, people who are newer to investing probably don't understand just how unloved and out of favor Macquarie was at that time.
Yeah.
Like, people thought they were going to go bust.
Yeah.
The share price was down more than 80%.
Yeah.
Like, it was dire.
Well, it radically changed their business to where it is today, effectively. So what a way to start your journey in markets.
What a buying opportunity.
I know.
Just a reminder that even the great stocks go through periods where you can really pick them up on the cheap.
Absolutely.
Anyway, that's not what we're here to talk about today. We're here to talk to James. But before we do, we want to say a massive thank you to Viola Private Wealth, who have been sponsoring this series and helping us keep all of our content accessible and free here at Equity Mates.
Viola Private Wealth manage over $2.5 billion for high net worth investors with $1 million or more. They help individuals and families navigate wealth management, from preserving established portfolios to intergenerational transfers and first-time investments. Their tailored solutions make your financial decisions clear, empowering, and aligned with your goals.
Charlie Viola is consistently rated one of the top advisors in Australia. We're not just saying that. Look at any list of top advisors, Barron's 100, whatever you want to look at.
Well, he's the top of our list.
He is.
Yeah.
There's more respected lists. And a number of the Equity Mates community are clients of Viola Private Wealth. Viola Private Wealth helps individuals grow and protect their wealth. To learn more, visit violaprivatewealth.com.au.
All right, well, without further ado, here's James Miller. Well, James, welcome to Equity Mates.
Fantastic to be here. Good to see you both.
Likewise. So to kick off with, investing is a lifelong journey, something that we always are trying to improve and become better at. With that in mind, we love to understand from all of our experts throughout this series, what are you working on right now?
Yeah, that's very interesting because I often say to my friends, it is this lifelong journey, but the thing I'm doing today is exactly the same thing I did when I started working in equity markets, which is trying to find stocks that are going to go up, that are going to beat the index, beat the market. But all through that, there's things that I'm constantly trying to improve. The big one being, you can have some big winners, but especially with markets like today, risk management is very important. Something we think a lot about at Firetrail, something at Macquarie as well. You can't eliminate all your risks, but at least try and mitigate what you can and focus your skill set on what you're good at and what I believe we're good at Firetrail and what I believe I'm good at. Or I don't know, talking myself up, but
go for it.
You got to
picking
myself
the
up.
We've got
stocks.
35 minutes of talking
picking
yourself
picking the
up.
stocks. So focus on picking the stocks, remove kind of the risks that you can't control as much as you can. second big one right now, noise. Like, I don't know, you read the newspapers, you turn on social media, I don't know, wake up in the morning, just the noise, especially out of the US, geopolitical noise. You've got to filter a lot of that out. I mean, keep your mind on investing, and investing is a long-term game. Trading is a day trading game, but investing is, in our view, we think 3 to 5 years at least. But really, if you think about your superannuation, you're still relatively young, like it's 30 years plus. So keep that time frame looking forward. Ignore the noise that isn't going to matter to your stock picks or your analysis. So keep that time frame long. The one I'm constantly improving, and every day I think about is it's logic, it's numbers, it's free cash flows and earnings. But to be able to have a really good stock pick, you've got to think a little bit creatively. What are you looking at that the market's not getting? What's the analysis that's the market got wrong? So you need to use both your kind of left side of the brain and right side of the brain out there as well. So it's all those things that really I think about day to day. And I mean, I think about a recent stock pick we made within the fund, a company called Fortum, which is no one's ever heard of this company. It's a Finnish utility. So you say utilities and people go quiet, and you say Finland and people go quiet. But we think it's a good stock. It's one of the best plays in AI. We think it provides clean energy, reliable energy, so hydro, nuclear energy. It's based in Scandinavia, and if I was an alien landing on planet Earth thinking, where do I build a data center? I'd build it there. It's cold. It's got cheap energy. You've got really good regulatory frameworks as well there. So that's a play that we think is a little bit left field, but still kind of thinking about the logic of the market today and the earnings and cash flow that are going to come out from that.
Nice. Stock tip in the first question. We could be on here.
Oh, if it's anything like our morning meetings, it's stock. So that's what we do.
So one thing that we're really interested in unpacking throughout this series is how expert investors learn, because it's such an important part of the investing process. You've obviously got to stay across the day-to-day noise that you mentioned before, just to make sure nothing's going to go wrong. But then when you're developing an investment thesis, you have to really understand an industry that you're investing in and the company that's operating in it. And, you know, it could be Finnish utilities one day, and you've got to understand, you know, the Finnish regulatory environment and the electricity market dynamics over there. And then, you know, the next day it could be like an American tech stock, and you've got to understand that. So what's your process for developing that like deep domain level expertise that you need to then make investment decisions on the back of it?
Take the noise out. Like it's so hard to do. Like every day I'm getting better at I don't know, using Microsoft Outlook features to kind of remove the 500 emails a day I get there. But you've got to focus on what matters and focus on a longer term time frame. And managing global equities out of Australia we find a great benefit, because you've got to do that. You're not going to be sitting there looking at the share price through the day in the US. You've got to think longer term when you're doing that. So we think about news, but only to the extent that it's going to affect a stock on a 3 to 5 year view there. The second one is think about your mistakes. What do we call them these days? Lessons. Think about the lessons lessons that you've learned, and don't just it's hard at the time because it's painful as a investor. You kind of feel that the stocks that don't go so well there, but you've got to learn from them. Like, was it a process breakdown? Was it bad analysis in there? Keep on doing that, and if you keep on doing that throughout your career, your investing horizon there, then I think that's a great way to kind of keep upskilling. I think about some of the stocks where we've got it wrong. I mean, it's not just buying the wrong stock, but it's like selling at the wrong time. I mean, Spotify was one of the ones that we had in the fund in the early days. There, we've been going nearly 3 years now with the global fund, and they weren't monetizing. Though we wanted them to push price, but they weren't doing it. So we sold out, and then what do you know? A few months later, they start pushing price. We can't even talk about it around the desk. Like, look at the share price there. But you've got to learn those lessons, and think about, well, should we have come back to it? Like, the analysis, the story changed. Was the analysis then going to be different on the stock? So things like that. Don't be surprised about things. We'll take a kind of logical approach to when something happens that you might not expect. How does it change that outlook for cash flows and earnings? And then finally, embrace new tools. Like we're lucky as a relatively small boutique Firetrail that we can take a lot of the AI tools that are out there today, everything from, we're doing a lot of things with our screening process with OpenAI and directly linking it into our spreadsheets, our processes through APIs there, to Perplexity. Like each one of these tools that is coming out, and the pace of change is really rapid at the moment. We think about, well, how can our process be improved by that? But sticking to that core of 3 to 5 years, cash flows and earnings, and focus on the things that matter for the company.
So obviously, as retail investors, some of the AI tools that you guys have access to and some of the stuff you guys have probably built in-house isn't accessible to us. But just at like a general level, where have you found AI most useful in the investment process? Is it in like the screening or like the initial research, or like is there a point where you're like, oh, the use case really hits it?
Straight up stock tips.
Yeah.
Yeah. Well, I think some people tried that, and I don't know how well that's going there. Yeah, which proves that the market's pretty smart out there. But really, it's the first half of the process. If you think about screening, like the global universe, there's 20,000 stocks plus that we can go invest in that are relatively liquid, that are genuine available investments to us and you as a global investor. So the traditional way of screening is you'd pull all those stocks in, you'd have kind of a funnel and narrow it down by things like valuation. We do a lot of stuff around smart valuation, so comparing stocks to their peers in their sector, not just the total market there. But what AI can do is bring in that unstructured data. So that's very structured data, and there's lots of data feeds you can get on that. But things like transcripts or other company releases where there's more, I suppose, qualitative commentary, that can come in. So it's that where we're finding it most useful is that first step before we go, right, this is a stock we really want to dig ourselves into in terms of the research process. It's that check of saying, we've done the quantitative process, is a semi-fundamental process that we're outsourcing to a AI sort of agent, and then thirdly, kind of, is that a stock that we then, as the humans, want to go out and really do our 6 to 8 week at least deep dive fundamental research, where a lot of things AI can't do yet, which is talking to the companies themselves, talking to the competitors, getting out there, being face to face with them as well. But a lot of it is available to just the general retail investor that's out there. That's what's unique at the moment. Like, Microsoft, ServiceNow, Salesforce, they're the ones like with Copilot and the tools coming through and starting to monetize there. But you can pay $20 a month for Perplexity or about $30 for ChatGPT. Those tools are tools that people can use and experiment, try them how you want, but always remember that check the sources of where the information is coming from. And privacy as well. Like, you got to be careful what you put into there, because if you put something in there, then it could just be out to the whole wide world pretty quickly.
Yeah. All of a sudden, Sam Altman's taking my stock tips.
Hopefully.
Now, James, we're witnessing a pretty remarkable year for markets at the moment, at the time of recording at least, certainly accelerated by the results of the US election. In the first answer, you spoke about, your constant quest to manage risk appropriately. So how are you thinking about taking advantage of what's going on in markets at the moment versus managing that risk?
Yeah, super interesting kind of couple of years in markets. We launched our active ETF S3 Go ASX in October 2022. And then the market, global market in Aussie dollars done 23% a year since then. So it doesn't really feel like we've had this big bull market, but in fact, it has been a bull market, which is quite unique, where you got equity markets doing that, and then kind of Main Street, the economy still feels pretty tough in most places around the world. The opportunity for us is that when you get times like this, you get the short-term noise creating potentially mispricings in stocks, and we haven't made too many changes so far after things like Trump and all that, but really on a 3 to 5 year view, we're thinking, where's the structural opportunities? And increasingly so right now, where's the cyclical opportunities as well? Structural things like AI, as we're talking about there, how to get power in there, things like even insurance. No one ever likes talking about insurance, but there's some super cool opportunities in that, such as Ryan Specialty, which will take the insurance that no one else wants to insure, and they're essentially the insurance broker for that, take a 20% commission, but none of the risk on that. So that's about a $15 billion US dollar company there. But on the cyclical side, like don't forget that a lot of the industries out there have been in a downturn for the last couple of years, like industrial manufacturing. They're yet to see much of a rebound. Even a lot of semiconductors. If you're just in semiconductors, which are for just general CPUs, Apple on the smartphones, like it's still been this COVID hangover where everyone was working from home, or a lot of people were working from home and bought new devices, and it's just been pretty much a downturn since then, since 21. So opportunities there. We think there'll be a smartphone replacement cycle soon. In agriculture, Deere is a recent addition to the fund. I'm sure you've heard of Deere, John Deere hats.
Yeah.
They don't just make trucker hats.
Yes.
They actually make tractors and agricultural machinery as well. That stock's been, the earnings of that stock have been in the doldrums really for the last few years. And agricultural commodity prices, corn, soy, which aren't just for food, they're things like biofuels as well. They're potentially set up for a rebound now. So we think it's a pretty unique time where you've got these structural forces plus potentially these cyclical kind of undertones and cycles coming through as well. So the joy of our fund is that we can play both of them and really look at that 3 to 5 years and try and add value to our investors above that.
Nice.
Well, James, I've got to say, I'm loving how many stocks you're throwing into these answers.
Yeah.
I reckon by the end of this conversation, we might be able to name your whole portfolio.
That's all right. That's right.
And yeah, please keep doing it. But I reckon you're going to struggle to get some of your current holdings into the next couple of questions.
Okay, we'll give it a go.
Because we want to go back to your early days and your introduction to investing and some of the lessons you learned from there. So take us back to, a younger James. When were you first introduced to investing?
Yeah, so younger James, he grew up in New Zealand, so I'm actually a Kiwi, and growing up in New Zealand, whether it's a function of being in a faraway corner of the world or something else, but New Zealand's a very kind of property heavy, doesn't really have much of an equity market development in there. So what I initially did when I left school is I studied engineering, so I did civil engineering and actually briefly worked as a structural engineer, so designing things like concrete beams, which is good because it's tangible and you can see it, unlike investing. But then really I got the opportunity to work at Macquarie, so just before the GFC, so great timing for learning lessons there, and that was an opportunity in small caps, looking at Australian small caps there. So started off doing that, so that was really when I really started to dig into investing itself, and why I made that switch from, I suppose, engineering to finance is that you've got the logic, the maths behind it, kind of using that kind of part of your skill set there, but it's also got that little bit of creativity you need there to be different. To beat the market, you do need to be different, so you can use both of those skill sets in there. So starting off in small caps, and is very much, a lot of it similar to what I do today, which is digging into a company, modelling out all those income statements, earnings, cash flows, etc., talking to the companies there, and you realize a spreadsheet can only go so far. You've got to talk to the company, you've got to talk to the competitors, you've got to understand the industry experts there, and for every company we look at, that's quite unique on how you do that. So really it's that process from New Zealand to engineering to starting at Macquarie in small companies, and then really moving up the kind of market cap spectrum, I suppose, into large caps, and then
from Aussie small caps to John Deere.
Yeah, exactly. Yeah, there's overlap. There, but investing's investing. I mean, wherever the stock is, and from the ASX, there's plenty of stocks here in Australia that could well be listed in the US, and there are the ones that are listed in the US. So often your geography of where you're listed doesn't really correlate too much with where the operations and what the earnings driver of the business actually are.
Talk to us more about your time at Macquarie. You've come in just before the GFC. The stock was down post GFC some 80%, kind of redefined the business, I guess, in some way, shape or form in terms of how they look at risk and whatnot. So how was that time, early days in the career? What did you learn from that?
Yeah, for me it was really the early learnings of how to think about risk, and from the Macquarie perspective, but also just looking at markets. There's a lot of things out there that you just can't control. You might think might even from a simple stock pick, you might think it's done well, but really, was it your analysis, or was it luck, or was it risk that went positively your way? So for me, the lessons from that were really just distilling in me that the fundamental analysis, you can be right on the earnings, but you might not always be right on the share price there. So do your due diligence, have a portfolio. Don't just kind of load into single stocks there. I'm sure we've all been there with kind of thinking a stock's going to rocket and when we all go all in on this. But portfolio is so important. So balance that risk. And that's something I've learned through to today, all the way through Macquarie and Firetrail, is that get your alpha, which is your excess returns versus the market from the individual stocks. But then really we sit down a lot with the whole portfolio and go through qualitatively, but also very quantitatively, where's the big macro risks? Like, is it currency that could go against us, or listing geography, or the sector thematic? Like, AI, the way we calculate it right now, is close to 23% of the global equity market from a direct basis. So this is direct semis, hyperscalers, technology there. Not even, everyone's starting to use it now, but like those risks, and in healthcare, GLP-1s, like how's that risk coming into play there? So it really instilled in me those early days just the importance of risk management and how to think about that and how to balance your portfolio versus your real conviction in the stocks themselves.
Yeah, it's going to be an interesting day the moment NVIDIA come out with a below expectation earnings call. Oh my gosh.
Now, we are talking about your early days, but you mentioned GLP-1 drugs, and I just want to take a bit of a tangent and just get your view on that.
I bet you do.
You guys are obviously talking about it. And for context, I want to share a quote that you may not have seen from the CEO of NIB, the health insurer today. Mark Fitzgibbon said, we'll all be taking GLP-1 agonists like Ozempic, like we do daily vitamins. What's your guys' view on that part of the market?
We think about it from an investing perspective. You got Novo, you got Lilly there, and there's if you look at the pipeline, it's basically an A4 sheet and very small writing of all the catalysts of all the trials that are coming up, and it's very hard to predict the outcome of a trial, even if you are very deep in the weeds as a healthcare specialist there. But our conviction in buying into Novo, which is the one we've owned for quite a while, is that when we looked out to 2030, so we went beyond our usual 3 to 5 year time frame at the time of investment there, the opportunity just from obesity plus diabetes in the US was still being undercooked by most of the market. So we were able to make the investment stack up on that basis there, like looking at that addressable population of over 100 million, about 110 million in the US, and that's not even thinking about the rest of the world there. So what's the US population? About 330 million, and what are we, 8 billion or so in the world. So yeah, still a huge addressable market without even the opportunity that everyone might be taking it there. So yeah, we do see a little bit of that out there, but to us, it's a drug which costs a fair bit of money to be reimbursed. Like, there's going to be a lot of hurdles, especially if you're with a US health insurer behind you. Like, you do need to go through a fair amount of hurdles before you can get I suppose your insurer to pay for it. And the out-of-pocket available market for those drugs, in Australia it's quite expensive, in the US it's expensive, Europe's expensive as well. So what will happen over time is that the price will come down, but the population using it will go up. So I'll say, in direct answer to your question, potentially there, but we're just seeing this catalyst pipeline come through, and I think we need a few more studies before you see that.
Yeah. Well, James, let's get back to your story. We might take a few more detours as we go. But,
heavily.
I guess over your time at Macquarie and then now at Firetrail, have you developed a personal investing philosophy?
I've tried. I've tried, and one thing I've learned is that nothing works all the time. You've got to kind of have your process, believe what you believe, and in terms of our philosophy, which I very much believe in at Firetrail, share prices follow earnings is the most important part of it. If you can predict the earnings of a company 3 to 5 years forward, then you've got a pretty good chance at predicting the share price of the company. So focus your energy on that in terms of doing that. In terms of stocks that kind of really have worked well for me over time, things I like are kind of stocks that are ex-capex. So if there's been a big investment cycle, particularly in sort of commodity style stocks, you can come in after that capex and then just harvest the free cash flow as well. So while that comes up, I mean, Chorus was an example of that. I suppose in my earlier days in New Zealand there, which is built the fibre network out in New Zealand. So it's costing a lot. We know from the NBN in Australia, it costs a lot to roll that out. But after it's done and you get the kind of this regulatory framework in place, then you can get really strong free cash flows coming through from that. So that's one there. I've tried a lot of times in terms of turnarounds, looking at stocks there, but if you try and pick the bottom, you might get dirty fingers or something like that. Yes. Something I've heard before. But to be successful, you do need a lot of the macro behind you as well in that sense there. But in the Aussie days, had good luck with BlueScope Steel, which negotiated really well with the unions and really restructured their cost base at the same time that China was starting to hum again there. So and stocks like that can be possible there. But focus your energy on what you can control and what you think you're good at, which we believe is earnings, and I believe is earnings. Keep an eye on where market expectations are. Increasingly, what we're finding is that a lot of the sell side, which is as institutional investors, the broker notes that we read and we get access to a whole bunch of them out there, increasingly find they're sometimes quite stale. So you have one set of expectations from what you can read, but then the buy side might be, which is the institutional investors, might be quite different to where even the retail investors might be. So it's always a constant juggle of trying to gauge where market expectations are for a stock. I mean, if earnings expectations haven't moved and the share prices have started going up significantly, that's often an indicator that expectations are starting to build up. So we're often pretty cautious when that's happened there, because you got to meet or beat expectations is one of the ways to make money.
That's the game.
That's the game.
So James, you started in the small caps. Now you're in the big caps, or large caps.
Mega caps.
Yeah. What are the major differences when it comes to like analyzing the two and characteristics that we can think about when looking at the different parts of the market?
It's different, but still very much the same. Like it's the same thing that drives these companies, whether you even think about a private investment or a personal investment in your local cafe or something like that. How do you think about it? You think about, well, how am I going to get my return? Is it going to be the cash flow? Is it going to be someone coming at a later date and paying a higher price for what you own? All those things hold true. What I find in, I suppose, the global markets versus the Australian markets is that you do have investors from all over the world kind of chasing a lot of stocks. So in some of the mega caps, like, you've got to realize you're competing against a lot of people there. And if you think about interest rate decisions from the Fed or something like that, there's millions of people trying to guess what they're going to do at the next meeting there. So you can spend your time on that, or you can be a lot smarter and spend your time on where you can really add value. And to us, where we find the sweet spot is, where I've found the sweet spot is in global, is more that global mid-cap space there. Heaps of opportunities which still don't have that much broker research out there on them. There'll still be $10 to $15 billion market cap companies, which from a global perspective we call a mid-cap company. From an Aussie perspective, you'd call that a large cap company. But heaps of those opportunities out there that you can go and research, get really good access to management, go and visit the operations, and a huge opportunity for the market to catch up to you, which is nice in terms of where the earnings are.
Yeah, nice.
So James, we want to turn to some lessons for our audience so they can take away and internalize it and I guess apply in 2025. And we like to start this section by asking this question, which is if you had to set up a portfolio for a retail investor for the next 30 years, how would you go about setting it up? And it can't be 100% in the Firetrail funds.
Okay. I'm out.
Yeah.
Often I say to the team, I'm like, they go, how are you investing in? Well, it is in the fund, but I often say then, well, all equities all the time. But that's really a reflection of, if you've got 30 years to invest, like, that is a long time frame. So don't be afraid to take a bit of risk within your portfolio. But if you do have to pull the money out in a shorter time frame for a house purchase or some other large purchase, then just be aware that you might need to bring your risk tolerance down a bit. So for me, 30 years, and that's a lot of people's superannuation there. If you're still young, then don't be afraid to really go into some more high growth assets. And you've got to, sometimes you put in balanced options, but really for most people, the growth option is still pretty good. And even when you get closer to retirement age, I mean, say you're 60 or so, I mean, life expectancy will be getting closer to 90. Like, it's still 30 years to go.
Yeah,
So
I know.
This question should be like 60 years. You're investing for the next 60 years. So think about that. Another general advice, I'd just say, look, don't be too jumpy with your portfolio. It's something tempting, and especially when you're first starting off, to go, well, the stock's, I don't know, 5 or 10% move overnight. Should I be jumping out of that and into something else? It's pretty hard to make money that way. I'd say if your thesis for why you invested has broken down, then exit the stock. But if you're just getting these moves which are just on really general news flow rather than analysis, then I'd be tempted to often hold on, probably more often than not there, because when you sell, the things you can control, your trading costs, stuff like that, your taxes, capital gains, etc. coming through there, those things will hit you if you do that. So do that, take the time frame, take a bit of risk, keep it simple. Yeah, don't overthink things. If you've got conviction in something and you want to give it a go, then yeah, give it a go. Keep an eye on it. Don't watch it hourly, unless you do want to kind of contribute money to one of our stocks like Interactive Brokers, which will enjoy your commissions, something like that. But yeah, take a bit of risk, extend your time frame, and don't be too jumpy about things.
Nice, love it. Well, if you were to go back to early days Macquarie and have the ability to teach yourself one lesson, what would that be?
I guess in terms from an investing viewpoint there, you've got to think about where you're putting money. Like, are you going to be passive about it? Are you going to be active about it? If you're going to be active and do it yourself, then yep, it's going to take time. It's going to take a lot of thinking time as well. So not just time, but kind of headspace time to think about your portfolio. If you're going to be more passive in your investing, then you're probably your right call is to give it to a fund manager or think about an index, but really just think about that. So yeah, early days, just chip away, and it's, I'd like to say I've broadly done this over time. Just chip away, keep contributing to your super, your investing as well. Save what you can, understand what you can control, your fees, your taxes, your trading costs there. Be true to yourself. If investment's gone well, is it luck? Was it skill coming there? So that's always one to think about. One that was taught early on to me in Macquarie, and it's really through meeting a lot of management teams, is thinking about incentives. I mean, if you think about a company, if you're listening to a podcast or something like that, if you're listening to management of a company speak, if you're reading the news, like, what's the incentive of that information that you're getting? So to break it down to a company, a management team is incentivized to get the share price higher. So often you'll go to a meeting and you'll go, oh, might be a bit dubious about this company, like I'm a bit worried about earnings. You come out of the meeting and go, oh, your management really kind of calmed me down about that. And I've learned to think, well, their job is to calm me down and kind of get the share price going higher. But it doesn't just apply to that. It applies to news flow. So, I mean, newspapers are there to sell newspapers in terms of the stories that come through there. Management do it as well. So you just think about where your information is coming from and just be smart and kind of thinking about that, especially in the age of social media with all the information that's coming through there. So do a bit of your own DD kind of behind the scenes rather than just acting on the information that you're getting there. And the best outcomes are when you get alignment. So when a management team is aligned through, I mean, a lot of the times you look at their how they're remunerated through total shareholder return, through EPS growth. Like, if they achieve those hurdles, then you as an investor are going to achieve your hurdles as well. So think about alignment of incentives, which can be a bit nuanced, but if they're aligned, then things are made a lot easier, because deep down, everyone likes to do what's best for themselves. Think about it. We won't go into a psychology podcast, but it's something I've seen from many management teams.
No, I love that. And final question, James, as we wrap up. Over the years here at Equity Mates, we've heard a lot of conventional wisdom in the industry. I think.
Oh yeah, like what?
Just there's a lot of sayings. Is there any conventional wisdom you learned early days, or you heard even before you were in the industry, that you think is wrong and should be ignored?
I think everything is wrong at one point or another, which I think is the one to think about, is that nothing works all the time. No matter if you've got the best strategy out there, it's impossible to beat the market all of the time, day in, day out there. So constantly refine how you go about your research, how you go about your investing, how you think about your process. Don't throw it out and kind of rechange it all the time, but just always be refining how you think about things, because that process of how you're doing your research isn't going to work every time. And don't get down in the doldrums about it, but make sure you learn from that there. So nothing works all the time. This time is different. What's the other ones out there? Buy the dip, or often don't buy the dip.
Okay.
Don't buy the dip, yeah. So downgrades coming in a few in groups sometimes there. So especially when the economy's being a bit tougher, you've got to think about kind of at the point at which you're investing there. I mean, it's been compared to when I started investing, like valuation is very important, but valuation, catalysts and earnings all together more than ever, very important. A stock can be cheap, but it will stay cheap unless you get those earnings meeting or beating expectations, or some of the catalyst coming through there. So yeah, there's no one specific lesson per se, but just keep on refining, because nothing works all the time. We're talking about AI, for the past couple of years, but is that going to be the big thing in 5 years? As we get closer, we'll know. You can have me back on, and we can talk about the agents. You guys might be robots by then or something like that.
We might have cloned our voices.
It's not
on a beach somewhere.
Absolutely. It's definitely around the corner. Well, James, that does bring us to the end. Thank you so much for coming in and taking the time to speak with us today, and the Equity Mates community certainly took a lot out of that, so we really appreciate it.
Thank you both. Thanks for having me.
Now, before we go, we want to say a final thank you to Viola Private Wealth. Viola Private Wealth turned complexity into clarity. With a highly personalized approach and proven track record, they simplify wealth management so you can focus on what matters most to you. For more information, head to violaprivatewealth.com.au.
Now stick around, because next episode we are interviewing Scott Phillips, who is perhaps one of the best in the business when it comes to, I think it comes to clearly articulating what good long-term investing is.
Yeah.
I always leave these conversations from him just so enthused with long-term investing. It's just a big pump up. I love hearing from him.
Yeah, couldn't agree more. He's just top of the charts when it comes to financial education in this country. Scott Pape, Scott Phillips.
Equity
Mates. Maybe there's something in the name Scott.
Potentially. Anyway, we'll figure it out next episode.